All right. Thanks for tuning in to another episode of WuBlockchain podcast. And today we have a special guest who's Smokey, a co-founder at Berachain. Hey, Smokey, how are you doing today? Thanks for coming.
Hey Shang. Yeah, I'm great. Thanks for having me here. How are you?
I'm doing great. I guess to kickstart our conversation, could you please just give us a quick background of Berachain? And I guess in your words, what really sets it apart from other layer ones?
Yeah, for sure. So in short, Bearchain is an EVM-identical L1 built on proof of liquidity, which allows users to turn their liquidity into security and helps the network power the applications that are built on top of it. When we think about what actually makes Bearchain different from all these different copy-paste L1s that we've seen over the last few years, I think there's a couple different things. One, starting with the tech stack. Bearchain is the first, L1 apart from Ethereum to be actually EVM identical. And what that means is that we're not just maintaining a fork of Geth, we're not just maintaining sort of something that's EVM compatible. You actually have the full EVM end to end. The one can run from a number of different clients, whether that's Reth or Nethermind or Aragon or what have you. So anything that's actually being built on mainnet is automatically or can automatically be upstreamed to Bearchain effectively. So as different EIPs come into place, as different compatibility requirements go live, as different scaling solutions are implemented on mainnet, the same can be applied to Bearchain. With the difference being that we use Comet BFT consensus under the hood to enable single slot finality. So we really see that as a best of both worlds type of approach that allows for a pretty interesting modular system for building chains. The more important part that we think about a lot is actually proof of liquidity itself. And what proof of liquidity is a simple resistance and or consensus mechanism, depending on how you want to look at it, that actually means that the block rewards on Bearchain are tied to liquidity being brought into the system. What this actually means is that when you look at Bearchain as a whole, it is the first ecosystem that actually does two things. On one hand, it allows users to actually earn more block rewards, or rather, block rewards on the network to be dictated by the liquidity provided to the network, and actually, ties the incentives for liquidity and security together at the chain level. And then the second part, which I think is even more important over time, is that it effectively allows applications on the chain to draw on emissions from the chain itself. Such that applications have a meaningful economic reason / are mechanistically incentivized to build on Berachain in terms of bootstrapping their liquidity and increasing their capital efficiency. To give a little bit more context on what that actually means, it means that block rewards kind of flow in the opposite direction on Berachain. Typically in a proof of stake network or delegated proof of stake network, you have validators that are earning block rewards and or their delegates if it's a DPoS network that are earning portions of those block rewards, and those are they're just going to the validators, and if it's a DPoS network, then the users, right? They don't actually necessarily flow into the ecosystem, into the applications that are building on top of them. In fact, there's actually no L1 or no L2 as we see it that is necessarily incentivizing or really serving the applications themselves. And the way that this works on Bearchain is that each validator has a set of gauges that are similar to curve gauges, if you think about it like that. And when a validator wins a block, they choose which different pools on the network and which different applications they would like to direct those block rewards or emissions towards. So it means that when you look at the flow of value or the flow of incentives on Bearchain, it actually goes from the validators to the applications to the users of those applications. So the chain is actually helping to, bring in acquisition costs or to bring in acquisition volume for the users on the chain itself, and helping, give those applications a boost, if you will. So that really means that the validators choose which protocols to direct their emissions towards. This starts with a set of very basic DeFi primitives that are built into the chain. So there's a DEX, there's a perps vault, and there's a lending market for the stablecoin Honey that's live on day one. But over time, it actually can extend to any application on the chain as voted in via governance. So you can be having, an NFT marketplace, a, delta neutral yield vault, an options protocol, a gaming protocol, whatever it might be, and actually tap into the emissions to improve liquidity itself and have those validators directing emissions towards your pool or your protocol, as opposed to effectively running these sort of, highly inflationary and liquidity intensive liquidity mining programs. So that's like the very high level. Can dive in a little bit more with greater nuance to give a little bit of a sense of like why people should actually care about that.
Yeah, that's fascinating. Just want to be clear, for example, for the validator to be able to get that block reward, does it connects to how much liquidity that is under that
To an
validator?
extent, yes. Yeah,
Okay.
yeah. So I'll talk about the validator process. So basically, validator Berachain follows ETH2 spec. So like you can basically spin up an infinite number of validators over time, etc. It starts with a relatively permission set and then can expand over time. However, what that really means is that there's actually two portions to running a validator on Bearchain, because Bearchain also has effectively two tokens. One, which is BGT, which is the non-transferable soul-bound rewards or emissions token of the network. BGT is what's used in governance, and BGT is what validators use to effectively determine which pools they're going to incentivize, and where they're going to choose to direct their different proportions of emissions. And then there's BERA. BERA is the basic gas token, and BERA is what's used to pay for transactions and fees on the network, and BERA is what is staked. So a validator posts a bond in terms of staked BERA in order to sort of like activate a validator and to come online. But then the way that it works is that the proportion of block rewards, or the amount of BGT that a validator earns every time it wins a block, is based on the amount of BGT that's delegated towards it. And the amount of BGT that a validator, that a validator effectively has, it only comes from users who have provided liquidity in the past, right? So while it's not one-to-one, it's not like, hey, if you've provided X amount of liquidity, you will earn X amount of block rewards. It is actually proportional in that a validator's block reward, when it proposes a block, will be larger if it has more BGT delegated towards it. So at any point in time, any validator has an equal chance of proposing a block, but the size of that reward is based on the amount of BGT from liquidity providers that have been delegated to it.
Can I understand it as like validators are kind of like a VC fund, like kind of like a fund manager that,
in a sense, I guess
chooses the best upcoming projects that can create the most activity. If that makes sense.
I think that's a great way of thinking about it. Of course, keeping in mind that it's fully non-custodial, and validators are never actually handling users' assets per se. But it does mean that validators effectively act as I guess advisors of sorts. I have to think about the best terminology there, but they're allocators, right? Yeah. They choose across the network where the emissions should be going. And I think that also means that you can very much have different risk profiles from those different validators as well. And where that actually sort of goes to the next level is when you think about the incentive marketplace that can be built on top of that. And that's where you probably can draw an even cleaner validator VC-esque analogy. Because what one can actually do is have a validator work directly with a protocol to bootstrap its own liquidity. So as opposed to a protocol having a program where they say, I'm going to pair my token against BERA and then give out a whole bunch of emissions in the form of my token, and whatever amount of delegates I attract, or whatever amount of users I attract, so be it. A protocol can actually work directly with a validator and say, hey, I'm going to incentivize you with X amount of my token in exchange for Y amount of BGT, right? And you can actually basically allow the free market to really take hold here, and use that to effectively decrease the cost of capital for a protocol, because instead of just paying out more emissions in the form of their own token, they can actually distribute their token to that validator and its delegates, and in exchange earn rewards in the form of the actual emissions token of the network, BGT. Right. So in this case, validators can choose to take bets on earlier stage protocols that might be riskier, but might also have more outsized return profiles that might return more for themselves and their delegates over time. Or they might simply like a given category and think that it could be a good source of I guess new interest in the chain, whatever it might be.
It this BGT only factors in the amount of TVL for when you get a reward, because I was thinking of a scenario where, for example, like GameFi or other applications who doesn't require large TVL, but the risks are much higher than let's say like a ETH USDC pool.
For sure.
How do you balance that in terms of the volatility?
Yeah, no, it's a great point, man. I think that when you think about the application there, it really is depending on what action is being incentivized. I think to start, it is very much based on liquidity being deposited. But there's also designs that we think about, or sort of microtransaction type formats that could evolve down the road, where one could have, effectively those emissions being proportioned to the amount of volume or the amount of fees, et cetera, generated by a pool. Right. So I would say that those will likely be a little bit more complex and not necessarily out the gates. However, over time, there are 100% things that will be valid there. I think the simple case, or the more facile argument, if you will, when thinking about it for gaming or NFTs or stuff like that, is that in many cases there will still be staking pools, or still be some sort of 4626 type tokenized vault deposit within these applications that allows users to get exposure or something like that. And in many cases, games will also want to incentivize a lot of their token supply to go in there. So that ends up being perhaps one of the simplest places where this could be applied.
Yeah, gotcha. That makes sense. Now, I have a question. I think you're probably one of the greatest person to answer this. Do you think meme projects and serious projects really can converge? I'm quite curious if you can share with us, what is it like for Berachain, right? You guys raised over $100 million from institutions, and obviously, very successful from VCs, but also you guys kept a strong meme game going on and a strong community. I'm sure there are a lot of funny stories, when VCs doing their DD, they go on Twitter and find out people flooding Berachain. People just copy pasting Berachain's fake, Berachain's not real. Yeah. Well, in fact, it's just part of the meme culture at Berachain. How does you pull this off?
Yeah, it's a good question, man. And I think that what we've seen, or what has become more evident over time, is that I actually think the best tech ends up being very memeable. I think that there's a lot of things that we see on the market right now that people really don't care about, and that we actually see lacking any degree of memetics or culture. And I guess when you think about memetics, it's often a means to an end in the form of distribution, right? And I think that we're also broadly seeing the market converge on a thesis that after product meets a minimum threshold of some sort, then distribution really is what matters above all else. So to answer, I guess, the first part of your question, I think they very much have to go hand in hand for a successful product to exist. Even think about something like Eigenlayer or Celestia, right? Two of the more technical or technically perceived, yet fairly mimetic projects that have come out recently. I would say that Celestia sort of caters more to your right hand, or they both cater more to your right curve memers, right? Where we're talking about blob space, we're talking about what data availability actually means. But then there's also narratives built around that in terms of modular money and modular expansion, so on and so forth, right? Or what the fuck intersubjectivity is, right? Or what a work token's supposed to be, or what the fuck restaking actually is. All these things end up being meme to some extent, and I think that is actually something that's admirable, right? You want to be able to make a concept that is technical and difficult, accessible and simple enough for people to bite size and turn into a meme. If you can't, then it probably indicates that your content is in many cases too difficult for someone to actually access. So, in our early days, I think we definitely had folks who were like, yeah, this is a joke, right? This isn't actually real. Because, at some point in April, the last, late 22, early 23, the whole meme was the psyop of Bearchain does not exist, which is really funny. But I also do think that after enough social proof and actually after enough seeing real builders and real signs of life, if you will, within the ecosystem, a lot of people were able to come around on that. And I think that you actually got, in some cases, an even stronger effect when it's someone had written something off and then they meet the team or they get to explore the ecosystem a little bit and then they're like, oh, fuck, I guess this is very real, right? So sometimes you get that double down effect that's kind of nice too. But I think that we've gone too far in the past, and now I think we end in a very happy medium where it's yes, it's obvious that we're pretty lighthearted and tend to have fun. But it's also, I think, relatively obvious that we're building something serious and real at the moment.
Interesting. I guess it seems to me that VCs are kind of more, favoring projects that have a meme culture than ever before after, we're seeing this shift in retail interest. Do you agree?
Yeah, I think so. Well, I think to a point, right? I know they're looking for stuff that has potential of memeability, but strong fundamentals. And it really does depend on each VC. But I think that more and more of them are realizing that it has been incredibly possible to mid-curve by over-indexing on technical innovation over the last few years. Because if you don't actually achieve a strong go-to-market strategy, if you don't actually get the distribution for that technical innovation, or if it is not an incredibly, incredibly critical part of the stack that, a given ecosystem could not live without, then no one cares, right? And I think that we've seen a lot of people, we've seen a lot of the best minds die in this like, weird, this weird chasm of like, hey, I built something really cool, but oh no, no one cares.
Yeah.
So I think that combined with the meme meta has definitely made people appreciate the importance of like having a culture, having, that sort of distribution funnel around your project.
Yeah. So how did you bootstrap the culture or the community in the early days? Because in the early days, Berachain was, to my knowledge, is just an NFT project. And what's the journey from an NFT project to building a successful venture? I'm quite curious about the secret behind the how the Bearchain NFTs just kept its forward during such a long mainnet development phase.
No, I think that's it's always been interesting. We started with the NFTs honestly just for fun, right? We had been, both myself and my co-founder Papa had been in the space since 2015. Mostly just initially like ETH Bitcoin guys, mostly ETH, then played the 2017, 2018 cycle. We're investing a whole bunch along the way. And I think that in 2021, we saw like, NFTs starting to develop and becoming more interesting, like Parallel, for example, and seeing more of a real like, utility NFT meta starting to exist. We weren't exactly sure what to do about it, but we just thought it was kind of fun. So we, made these 100 NFTs of bear smoking weed for absolutely no reason. Mostly we just thought it was funny. And then we basically raffled those off in a whole bunch of different like, DeFi focused NFT communities or DeFi focused Discords, not even NFT communities. So this is like Olympus, Frax, like, Curve, like those sorts of ecosystems that were a lot closer to like hardcore DeFi communities than NFT ones. And what ended up happening there is like, I think we actually ended up like self-selecting for a group of people that was like pretty mimetic and like pretty funny. But also relatively sharp and DeFi savvy enough to, choose to, on one hand, buy this NFT of a bear for no fucking reason, but on the other hand, to already be pretty active in these protocols that in many cases were relatively complex, right? So when I think about how that actually, evolved, it was then very much, okay, cool, like what can we do with this? Okay, let's find a way to add a cool mechanism to these NFTs such that we actually have like something more to do here, right? And then we basically made them rebase or multiply over time. So if you owned one of the first, one of the first collection, then you'd be able to get one of the second collection for free. If you owned those two, you'd get two in the third collection for free, and so on and so forth. While in each case, there was a little bit of extra supply that was minted to effectively allow for more distribution and new people to enter. And what this ended up doing was like, on one hand, it really rewarded initial holders. On the other hand, it ended up being a great like means of distribution as the supply grew over time, and the collections effectively became less scarce. And since it started from those same communities, it tended to like really continue growing within like similar communities. So often fairly like technically competent and or like mechanistically competent folks on chain, combined with folks who are pretty risk on and like jokes, like fun to be around. So I think it was actually after talking to those guys for long enough, plus just noticing what we'd been hearing from builder friends in the space, that we were like, hey, there might actually be a real gap in the market for us to fill over here to do something interesting with. Because, what we were noticing is that there were a lot of users within our community who were fairly, savvy on chain. And in many cases, they were thinking about whether they should basically, run a validator on ETH or whether they should effectively just like, LP in a DEX, lending market, whatever it might be, right? Especially sort of like DeFi summer 2.0 timeframes. And I guess the question that we found ourselves asking was like, why is it that has to be a choice? Like, why can't you sort of have your cake and eat it too? And on one hand, LSTs like EigenLayer, like LSTs like in terms of like Lido, /Rocketpool, and the EigenLayer ecosystem very much move this in the right direction nowadays. But it ends up being on one hand like not exactly a native / function of the chain, right? It ends up being something that you opt into. And on the other hand, it actually is only generalizable to like one form of capital, right? Ethereum. And I guess the other question that we posed was, why is it that only ETH or only a given gas token of a chain can serve as stake? When stake really is more than anything else, it's liquidity at risk, right? It's capital at risk. But I don't actually think that there is a meaningful difference between stake provided in ETH or stake provided in like I'd say Pendle or Curve tokens or whatever it might be, right? I'm just using a random facetious example here, but really it's about the economic value underpinning that security that's being provided. And I think that was like sort of one of our major unlocks, in which we thought, right now liquidity and security are against each other. How do we put them, basically on the same team? And then I think the other thing that we saw, like from talking to app devs, was that there was very little reason for them to build on, one chain over the other. It was okay, cool. Like, I'm building on Polygon because I've got this big grant, or I'm building on Near because they gave me like 1 million Near tokens. And it's like, okay, well, what degree of longevity or staying power does that have? Not very much, as we see it. It is very much reminiscent of like, this like 2021, 2022 zero interest rates phenomenon timeframe. And we thought to ourselves, maybe there should really be a way for a protocol to help support the applications that are building on top of it, as opposed to just sort of serving as a rent layer, right? And that was sort of where the rest of the idea of proof of liquidity came to be, in terms of allowing the liquidity providers and the validators and those who've contributed the most value to the ecosystem in terms of generally accessible liquidity to be able to actually help direct incentives across the network, really saying that those who have the most skin in the game have the most ability to determine outcomes across the ecosystem. So I think that was, this series of aha moments, if you will. And then I think that, that sort of ties into a broader thesis of ours as a whole, which is that if we want crypto to scale to, tens, hundreds of millions of users, then there really has to be an opportunity for applications that can only exist under crypto landscapes or in a crypto environment to become popular, right? Like the only way for people to actually want to bridge the gap into Web3 or into using crypto is if there's something that's important enough or accessible enough or desirable enough for them to use, so they couldn't get in like a Web2 environment, right? So on our side, the way we see it is that that's really a matter of shots on net. And what Berachain does is it acts as an accelerant, or I'd say really a booster for the application layer, because we're allowing as many different protocols as possible to effectively reduce their activation energy, to make it easier to get off the ground, to bootstrap their own liquidity, and to get to that point where they could actually really start bringing in meaningful degrees of consumer and customer adoption. And hopefully we see the next breakout app being built in the Bearchain ecosystem.
Yeah, that's great. Was there like a funnel, like you guys communicate between the team and the NFT holders, or is it just like people are just strongly believing in proof of liquidity and the whole concept?
Yeah, I don't think we ever like sort of. I think we bounced the idea around with people a bunch, but it was never like, hey guys, like, do you think we like can we do this? It was very much, hey guys, like we've built this community, we have resources, let's do this, right? And I think people kind of rallied around the idea, because it was also one of those things that was stupid enough to be like worth seeing, right? It's like, hey, these guys made an NFT community out of like multiplying bears smoking weed, and now they're going to build a blockchain. Like it's one of those things that sounds silly enough that you kind of want to see it happen, right? So I think that also was sort of going for us.
Nice. Currently, the crypto community, especially among like retail traders, have a strong resistance against like VC funded projects, because they have a high FTV, and almost all of them for the past few ones performed quite poorly post TGE, while meme coins are getting very popular. What do you think about this?
Yeah, I think it's multiple reasons, honestly, man. I think on one hand, a lot of the projects that we've seen perform poorly are ones that have had very little like built out that people care about, right? And they've had very few opportunities for like wealth creation events, right? I think that the thing that caused a lot of the L1s in the past to rally, or L2s for that matter, and to have a community formed around them, was actually the opportunity for people to like make money, right? And I don't think that's an incredibly hot take. And I think that the part that people often miss is that isn't just the gas token. That's actually everything else that's built around the ecosystem, right? So the way we think about that is, especially in the context of new chains or new ecosystems, is that the metagame to date has very much been, raise a bunch of money, say there's going to be an ecosystem, launch the chain, there's like nothing for like, a few months besides maybe a DEX and a lending protocol if you're lucky, and like there's maybe some like scammy NFT marketplace. I think we've seen that a lot of times. And I think having seen that, we knew that it was the stupidest approach possible. And our goal has very much been to sort of cultivate a pretty meaningful ecosystem, such that when Bearchain goes live, it's not, some empty, wasteland that you can't really do anything in for months. On one hand, as I mentioned, there's sort of those core primitives built into the chain, which ends up being, on one hand, a source of value accrual to BGT, but on the other hand, something for users to use right out the gates. And then beyond that, there's like a host of close to 200 projects, of which 60 plus are native groups that'll be deploying on Bearchain pretty early. And we think that a lot of those will actually demonstrate the value of an ecosystem, B, help burn gas, etc., and C, have tokens that have opportunity for wealth creation events for even those at sort of lower retail portfolios as well, right? I think it's tougher to bet on something going from 9 figures to 10 figures than it is on something going from 7 figures to 8 or 8 to 9, right? And I think that that's part of what has driven the appeal for meme coins, and part of what I think can bring appeal back to sort of like L1 or L2 environments. In terms of like simply not being a scam, I think we've seen a lot of stuff recently that has been a highly decorated scam without much actually, present to show. It's been a series of fluffy partnership announcements and like, trust me, there's, big things coming, but with very little to show for it. I think on the other hand, we very much prioritized a culture, or I'd say an ecosystem built around like a lack of genericism, right? I don't, we don't want to see the next Uniswap fork or like another Aave fork or like, the 30th version of like what OpenSea looks like on Bearchain. We want to see interesting new primitives that haven't actually been developed before, because we think that that's what actually allows for retail to win, and that's what actually allows for net new people to be drawn into an ecosystem, causing appreciation across the board.
Cool. Do you think it had something to do with airdrops? It's probably like a hot take, but something I've been thinking about is like these tokens need to find a demand. In the past cycle, there weren't airdrops, especially for L1s, L2s. So whenever a blockchain launched, they don't have to really worry about demand from retail, because unless they ICO bought it in pre-sale, chances are if they want to speculate, then they have to purchase, like buy the tokens. Well, in this cycle, because of, I guess, one, regulatory reasons, and second, there's so many competitors, you have to draw attentions among there's so many other chains, so we have to incentivize people to via airdrops. Do you think that is like a reason why that these tokens perform poorly post TGE, or is like, what do you think about airdrops in general?
Yeah, I think that airdrop design is very difficult, and is one of the areas that probably requires a little bit of innovation. And I think it's something that's increasingly turning closer to like liquidity mining or developer acquisition of efforts than it is anything else. I don't know if I'd agree with the first part though, right? Because like if you look at last cycle, like Optimism, Arbitrum, like there were a lot of like L2s that are still at massive market caps right now that did pretty meaningful or like non-trivial airdrop campaigns, right? Because in any case, you need some manner of distributing and getting that initial float out there, such that you don't have like a super like high FTV low float project, right? But I think that what has happened is like we've seen a lot more money come into the private markets, and that's caused a lot more projects to launch at like pretty inflated valuations, which means that like that effect is felt that much harder when there aren't as many marginal buyers, right? And there's a lot more marginal sellers. I do think the average utility of an airdrop has decreased, and I think that they are retaining many fewer users than they were in the past. I also do think that institutional airdrop farmers and like these like effectively like farming operations have also increased in complexity and nuance, and are very much more talented than they were in the past, which is another added burden.
Yeah, it's industrialized.
No, there's this like massive operations there, right? And I do think that in the future we'll probably see airdrops turn a lot more into something that ends up being a more tangible source of value accrual to the project. Because right now, I people think of airdrops as a means of getting distribution. I think that a lot of people don't actually, end up getting the distribution they want. And I think that beyond that, people also think of airdrops as a manner of like improving sentiment or like how the market feels about people, because it's also somehow become like an industry standard to like give free money to folks, which I definitely find pretty weird as well, just like logically speaking. So, I think the way that we approach it is that we care a lot about a few different groups. One is the original community that's helped us get here, which has been with us for 2.5, almost 3 years. I don't think the Bearchain would exist without that, so we care about those guys a bunch. Two is we care a lot about developers and those who are actually building in the ecosystem. And as I mentioned, we're fortunate to have like a ton of folks who actually want to build on Bearchain, and a lot of them have already taken the time and effort to deploy and do a lot of work on mainnet or on the testnet. And we care about those folks because they've helped us, improve our software. They've helped us build a better ecosystem, and of course, they've been able to help demonstrate that there's people who want to use this thing. We care about the folks who are able to, help test the different products and test the testnet itself, and actually participate in the network at its earliest stages, because there's a lot of work that goes into that process, and it's never, the easiest or nicest thing. And then I think we care about a lot about like new liquidity and new entrants entering the ecosystem, right? So I think it's very possible to design an airdrop that is elegant and rewards the parties that have contributed the most. I think there's always going to be lots of butthurt people who are like, oh, how come you didn't give me free money? And I think that's just like, I don't think you can make everyone happy. But I definitely think that, when looking at projects that have had successful airdrops, I would think about, Celestia, I would think about Jito, I would think about Athena. In many cases, they have not set expectations incredibly high in terms of, what that airdrop will look like. And they've also built a product that actually has a good bit of use, right? All those things are critical solutions for different parts of the stack. So I think that that perhaps is the under discussed portion. In that, like, airdrops can be pretty bad, but if you build a good product, I also think that makes it easier to have a good one.
Yeah, it totally makes sense. I think the next part is the next part of my question. Just want to maybe dive into the proof of liquidity mechanism, and perhaps I'm not sure if it's applicable. But do you think the fact that you have two tokens, BGT and BERA, can sort of solve the problem that we're discussing here, like balancing the interests and kind of also like aligning the right community while also rewarding them properly?
I hope so. I don't know if it's necessarily in the context of airdrops, but I think it's more, a long-term perspective. Yeah. I think what having the two token system for Berachain actually does is it effectively allows for people to choose what they care about most, right? It embeds choice into the protocol itself. In that, and to be clear, right, it's not two tokens for the sake of two tokens. It's actually because if we want to maintain the ethos or the structure of proof of liquidity, it's important for BGT to be non-transferable and soul-bound, right? Otherwise, people could just buy it, and then it kind of defeats the point, which is like you have to provide liquidity to earn block rewards, right? So I just wanted to highlight, because I think we've had people ask us in the past, like, oh, why do you have two tokens? And we're like, well, that's kind of the whole point of POL, right? But I think what it does is it allows you to choose your risk profile, or allows you to choose what you care about. On one hand, you can hold BERA, you can speculate on the liquid price action, if you will. You can use that to pay gas. You can think of that as a default, if you will. On the other hand, you can hold BGT, and by holding BGT, you can use that to effectively compound your rewards, if you will, in pools that you're depositing in. So, for example, you LP a stable pool, you earn some BGT, and then you choose to delegate that BGT towards a validator that's putting the majority of its emissions towards the same stable pool. Perhaps you actually earn more that way than you would have if you just held or sold liquid BERA, right? So there's an element of game theory there. You can also choose to use that BGT to stake with a different validator or to delegate to a different validator that's receiving incentives from a protocol that you want exposure to, right? And use that to effectively get a call option on something that you actually don't have to like buy or pay for effectively, right? So it's very much like a have your stake and eat it too kind of scenario. And then the whole time you're earning fees from the various applications that are being powered by BGT across the chain, right? So I think it allows you to take a more long-termist, perhaps like compounding type viewpoint versus a more like short-termist price action viewpoint, which I think is like probably healthy ultimately in a market, right? Because it means like you can figure out what your style of play is.
Got it. Could you paint us a picture, in your mind, what a positive flywheel is going to look like when Berachain goes mainnet?
Yeah, I think what we probably see is a few different things happening. I think that we see a number of protocols launching. And I think that at first we probably see a whole bunch of capital piling into the native applications and those folks earning a bunch of BGT and probably doing exactly what I mentioned, right? Like LPing in certain pools that are probably not super high risk, stable pools, majors, etc. And then compounding those LPs by basically choosing to direct more BGT towards the pools that they're LP'd in, right? So I think that's like sort of one part of it. Then I think as we see more and more protocols coming online, and basically submitting governance votes such that their protocol themselves, like it's the protocol vault, if you will, or their pool in the chain DEX ends up receiving BGT emissions, then I see more people starting to rotate into these and validators actually starting to work with protocols, start that incentive flywheel such that folks can actually effectively take riskier bets, right? And basically say, hey, I want to try this, mid cap, or I want to try this small cap coin, whatever it might be, right? You can even have, and I've heard plans for, POL powered meme coins, and what it could look like to actually have like a meme coin like BERA pair with a whole bunch of emissions on it from validators who are choosing to point stuff that way as well, right? And actually starting to have a little more of a positive flywheel there. So, in short, I think that the positive flywheel starts to occur when you basically have a number of protocols partnering with new up and coming validators. Validators partnering with new up and coming protocols, then users delegating their BGT to those validators or incentivizing those new protocols. And then for those, 1 in 10, 2 in 10 that end up working out and increasing massively, I think we start to see that effect recycling over the ecosystem. Like I think that a real massive amount of gains or alpha will come from people taking bets on the right protocols early in a manner that has very low risk to them by delegating to validators, which are incentivizing those protocols as well.
That's so interesting. That was for that to happen, you need to have very sharp validators that can correctly choose the right, early projects while they're not rods. While you also need to have users who constantly looking at new gauges,
best opportunities, of course,
and you just make that super engaging.
Yeah, I think the ideal metagame that you want to create, right? And I think something that goes underappreciated in many points is I think you want to be able to build a system that rewards people who put in more effort or put in more time to it, right? You want something that forces people to engage a little bit, and you want something that actually means that if you do the work, then you can have outsized returns.
That's interesting.
I think we've seen these in ecosystems like perhaps Blur in the past. I think you see this with Pendle, and when people choose the right YT/PT splits to actually play with, right? It's very much there are systems that if you take the right bets, which are obviously not obvious, but exist, then you can do much better than the norm. And I think that ends up being really important over a long term. And then I think there's also just the basic flywheel, to be clear, of hey, you LP in a given pool, that pool basically starts paying you BGT. That BGT is generating more fees. As a result, you're basically holding that BGT for longer. You're auto compounding it to your pools that you're basically taking part in, and then you're able to effectively continue having that flywheel of deeper fees, more liquidity, and rinse and repeat.
Yeah, so I think you guys actually created a speculation on top of I also like a new type of speculation, right? Where you can speculate on actually, in a way, the activities and popularities of a project or a token, which in the past I don't think existed, because is either just earned through validators or I guess MEV, or you have to actually purchase the tokens, which probably have a higher risk. What you guys did
I think what it's done
people can
it's sorry to interrupt you, man. I think it's taken a process that often happens somewhat under the table. When it comes to the MEV side, for example, or validators working with protocols, etc. And it's actually bring that very much more into a free market context.
Yeah, that's fascinating.
And I guess another way that you can think about it, or another, I think another useful mental model that people have had for it is that it is, it is in a sense a little bit like Curve at the chain level, without the vote locking multipliers, etc., and also allowing you to direct those emissions towards not only just any given pool in the DEX, but any protocol in the chain, right? So I think that extension is what ends up being incredibly exciting in terms of still having that correlation of like people who provide liquidity to people who have like governance or decision-making power, but done in, I'd say, a much more flexible and modular manner at a different, level of the stack, if you will.
Got it. So what are the sectors or specific projects that you're most excited? Maybe you can share with us a few.
Yeah, man. Wow. The trickiest part is like there's so many that it's tough to remember all the right ones at the right times. But I'll think about it for a second. Off the top, I think there's a few that are pretty exciting out of the gates. There is Puffpaw, which I thought was absolutely hilarious. It's the first quit smoking to earn / vape to earn DPIN on Bearchain. This one isn't like a big POL focused one. It's just a really cool project that I don't think I've ever seen exist before. In that you're effectively taking a behavior that people will already do on a very regular basis in terms of vaping, etc. And you're incentivizing people to do that in a more healthy manner, as in reducing the nicotine amounts, going to basically completely nicotine-free pods, etc. over times, and earning more tokens in exchange for doing so. And they've actually created a pretty cool economy. Team is super strong, has shipped tens of millions of vapes to leading tobacco manufacturers and vape providers across the world before. So I think that one's really cool. I think on the deep DeFi side, there's one called Exponents that I'm a big fan of. Has previously built multi-billion-dollar protocols and is now effectively building a new layer for speculation in terms of directional trading. So, I very much think about it as like the Uniswap moment for derivatives, in that Exponents allows you to use sort of the Uniswap spot arbitrage mechanism, scaled to the derivatives level, to combined with effectively a bribing layer to allow you to directionally long or short, a given token. With incentives. So what I mean by that is that you can actually have like perps, whether that be linear or power perps, on a given pair. Let's say it's like, with bonk, whatever it might be. And you can actually, you can incentivize people or bribe people to long one coin, or incentivize people to short the other coin. And I think that's just really interesting because it actually adds like a whole new level of like gameplay to the mechanics, especially for these like small to medium cap coins, right? It's not just how many people, like what's the open interest, or who wants long or short. It's also like what is the layer of people and what are they bribing me with to go long or go short here.
This is like trade to earn, long to earn.
Yeah, like it's exactly. So I think it's pretty interesting there, and it's just a new dimension. There's folks building really cool stuff in gaming, like Baritone. They've built like sort of an Animal Crossing / Stardew Valley farming / casual game. There's groups like Shogun that have already raised money from Polychain and Binance Labs, who are building effectively, I guess an intense solver network that allows you to trade any asset from any chain, which I think is very much in line with the UX improvements that we want to see in the future. There's groups like Gummy that are building a marketplace that allows you to borrow any asset against any other asset. So it's effectively, you leverage on anything with a very cool system that allows for, shared liquidity type liquidity profiles with isolated liquidity type risk profiles. There's Kodiak, which is building a really cool set of sort of concentrated liquidity plus automated liquidity management strategies with a sort of pump fund style like token launcher attached to it. I think that'll very much end up being like a go-to community / like altcoin DEX. There's groups like Over Under that I think are really cool that have effectively built sort of like an ML / computer vision algorithm that allows you to speculate on outcomes and automatically generate odds on different Twitch streams. So you can actually have people playing like, Call of Duty or League of Legends or whatever it might be. And you can say, you can effectively place bets on whether someone will use this gun or get X number of kills, etc., from the data that's being actually read off the screen, which is just another like we're pretty bullish on the consumer sector alongside DeFi. And we think that's going to be really interesting. There's guys like Concrete Finance, which I think are absolute killers, who are building effectively credit default swaps on chain and liquidations as a service, which we think gets really interesting as you sort of get to like more complex and I'd say sort of like nuanced stages of DeFi. There's Infrared, which is sort of like the go-to LST of the ecosystem that I think a lot of people have built really interesting primitives around that allows you to effectively get a liquid form of BGT to be used as a yield-bearing primitive within different protocols across the network, raised from Binance Labs recently, super sharp group that's done it all before, and eventually turns into like the convex plus Lido plus block building layer of Berachain. So yeah, man, that's just like a very quick highlight reel, but there's a whole bunch of stuff that we're seeing in the ecosystem, and there's a lot to be bullish on.
Yeah, there's a lot of interesting concepts. Very, very, very innovative. And is there a way for people to see them where they're doing stuff?
Yeah.
Where you have like a website for the ecosystem?
Yeah, so there's a website for the ecosystem. If you look at the foundation page, there's sort of an ecosystem highlight. And then beyond that, if you follow Bearchain or like folks in the ecosystem on Twitter, it's pretty easy to keep an eye on like a lot of the folks that are coming up and doing cool new things. I think that we see, no shortage of people, being sort of, I'd say prominently displaying their Bearchain affiliation.
Cool. So what mainnet?
Not too far out now, man. Mainnet definitely before end of year, hopefully in the next few months. So we're just, we're doing everything that we can to make sure this testnet is absolutely battle tested, and has very much improved from our first one, I believe. I think that the whole thing is it's sort of going back to what I said earlier, right? A lot of different ecosystems sort of have that first few months where they're like dead, right, and no one's actually building there. So I think the opportunity cost, if there's something wrong with the chain, is a lot lower. In our case, we know that there's going to be like, dozens and dozens of companies that are live there, like right out the gates. And I want to make sure that we are absolutely bulletproof such that, those guys are in the best position possible as well. So we're going to, take the time to do it right. And we're already quite confident in where things are at, wrap up some audits, and then go live as soon as we can.
Sounds great. What are the, it's probably my last question is since you mentioned about because Berachain is proof of liquidity, so you definitely want to make sure that everything goes nicely because it's a lot of tons of liquidity coming in on day one. And I noticed that you guys built a lot of native dApps built by Berachain. For example, the lending borrowing protocol, the PERP protocol. What is, I guess, besides obviously the security issue that you want to be, making sure they're not rockable? How do you view the role for these native dApps in the future?
Yeah, no, great question, man. I think they're meant to serve in two different purposes. One is the native dApps are sort of meant to be there to start, that initial BGT generation flywheel. And of course, like you said, to do that in a manner that's as safe and secure as possible, where you don't have reliance on effectively third-party dApps for generating the tokens that'll then control block rewards across the chain, right? So you definitely want to make sure that that's as safe as possible. And the other thing that they're meant to do out the gates, I'd say two things. One is to start that sort of fee generation flywheel, such that basically BGT is earning fees from those native dApps, and then on the other hand, such that you basically set a bar for quality for the ecosystem. In that, one of the things I talked about is how ecosystems at the start tend to be plagued by just a bunch of sort of shitty Uniswap and Aave forks, and we wanted to avoid that. We felt that by actually having these sort of like chain enshrined primitives, in addition to the other solutions that I mentioned, they actually make it a lot tougher for those applications to sort of like grift their way out, right? In that instead of having a bunch of liquidity split across 5 kind of bad dexes at the start of the chain, we would rather have that all in one, pretty decent one. And then ideally in the future, have other even better applications, replace the chain native dex, right? So the chain native applications are meant to serve as a baseline, but they're very much not meant to be the be all or end all. Right. So in a world where there's someone who builds a way better perp dex or a way better, full scale money market, etc., it would be much better if the majority of emissions are going there. But we'd rather just have it start from a stable baseline. So ideally they are obsoleted over time, but they have enough of an entrenched advantage per se, such that in order for them to be obsoleted, that next product that actually replaces them is really, really strong.
Got it. That makes sense. Do people earn BGT while using the native dApps, or I guess do they actually do that, or is it just part of the only the the people who submitted the liquidity?
Yeah, well, like the way that the way that you actually earn BGT to start, right, is by LPing in the native dApps. So like LPing in like the DEX, providing liquidity for the perps vault, borrowing honey, etc., will all be activities that can earn BGT, and that's actually how we expect the majority of it to start being generated.
All right, perfect. Yeah, that clears. That was a question that I was wondering.
Yeah.
Well, thank you so much for coming, Smokey. Do you have any final message for our audience?
Yeah, I think that all I'd say is that for us, we plan to spend a lot more time in the APAC ecosystem, in both China, Singapore, Hong Kong, Korea, and then Southeast Asia, Vietnam, Thailand, Indonesia, Malaysia, Philippines, etc., over the next few months. And we're pretty excited to grow our presence in terms of boots on the ground, in terms of protocols building out those ecosystems, in terms of different sort of trading groups, whale groups, farmers, whatever it might be. So I think that the simplest thing I'd say is that if you're a builder or if you're simply someone who's interested in Bearchain and figuring out how to get a leg up in the ecosystem, or what kind of things you should be looking out for, please keep an eye on us on different social channels, and please feel free to give me a shout or any of our team members a shout over DMs whenever. We try to be as responsive and as helpful as we can, because it's our goal to make sure that as many people know about what we're building and how it can potentially benefit them.
Awesome. Thank you so much for coming today, Smokey. It's been a enlightening conversation.
Of course. Thanks for having me, man.
Thanks, everyone.